This is something that really proud to be here, very excited about the presentation and having a chance to follow Murad and Jason. When it came time to put together, or to speak for Terrapin, spoke with Jesse and wanted to put together all of the, we originally had 3 different speeches partitioned off over a couple different days. When I saw what Murad was speaking about, what Jason's speaking about, and myself, really got a chance to put together and define some value and provide a segment of this conference about innovation in terms of identifying alpha and innovation behind that. I am a high-velocity cross-asset class trader, like Jason, make my money trading for a living. Author of the book, The Global Macro Edge, Maximize Return Punitive Risk. As a 9-year Marine Corps veteran, I've seen a lot of my colleagues come back with some, who've defended this country, suffering from different things. And so the profits from the book that's coming out are going to support veterans by placing service dogs with them. And hope that's not a cue.
It's editorial.
Exactly. As a 9-year Marine Corps veteran, I'd say that's probably one of the biggest things to be a successful trader today, was the discipline and all the things that came from that. I'm a foreign language enthusiast, having served overseas, living in Japan, living in China, majored in Japanese and Chinese, and went to Brazil last year for the World Cup as an avid soccer fan, and picked up some Portuguese and Spanish as well. And I'm based in a city that appreciates the art of speculation, like Chicago and Las Vegas. Simplicity is the ultimate sophistication. Leonardo da Vinci, 500 years ago, arguably one of the greatest minds in history. And when I approach things and when I try and come up with solutions for things, it's with that approach, the Steve Jobs approach, if you will. And so the goal of the presentation today, as Murad has put forth a very robust presentation for a robust methodology of identifying manager talent, Jason has talked about some of the key metrics in terms of regime recognition. I want to come in place that within the global macro edge itself, we talk about maximizing return punitive risk. And so I want to outline some of the shortcomings that are in the industry today, both in terms of compensated managers and in the process of alpha identification itself. Also want to talk about how a compensation structure based retroactively on return punitive risk can bring benefits for both the manager and the investor. And lastly, a famously named Netto number, which can be used as a tool to identify alpha and help you in your managerial process, both pre-selection, during selection, and post-mortem. So I always like starting things with a story, and for myself, I spent high school as a liquidity provider for those wishing to prognosticate on the outcome of sporting events. Yeah, I was a bookie. And I learned an amazing amount of lessons. There was a lot of practical application that came, which is probably no surprise now that I live in Las Vegas, having grown up in the Bay Area. But a lot of practical application came from being a bookie in high school. Spots of value, market sentiment, how making a point spread and seeing people that would, that want to bet on the teams to make them feel comfortable. There's a lot of analogies that you can bring over between buying, or between making a market and trading the markets. And probably the most important lesson from being a bookie in high school was learning how to innovate. Now, it's a shame that they showed up my high school diploma and I had to join the Marine Corps instead and go to college, but that's okay. But the need to innovate and to meet your clients and to adjust with the markets, that's what I took away. And this came in the form of the progressive point spread. Now, how many traders are in here right now? Excellent. Okay, how many of you have ever placed a bet on a sporting event before with a point spread? Exactly. Now, for those of you that aren't familiar, point spread is a very binary outcome. If the Giants are a 7-point favorite of the Chicago Bears, which why that would ever be, I don't know. But the Giants are a 7-point favorite. If the Giants win by 8 or 28 points, you get paid the same amount of money. So what happens is you can get these incredibly binary events. And in high school, I invented what's called the progressive point spread. So I built a model for point spreads that if a team won by 8, the payout would only be partial versus if they won by 28. So you were being fairly compensated for the degree of win based on that point spread, okay? And I think as a teenager, as an adolescent, that was kind of a cool little innovation to give my clients to dampen volatility in my betting portfolio and induce them to bet more money because of the risk-adjusted returns. I promise. So under that spirit, I present the solution today in terms of redynamicizing and reinvigorating and recalibrating how we both approach alpha and how we compensate for it. So, in the book, The Global Macro Edge, we had a chance. I started this book 4 years ago. It comes out later on this year. And I could have written another book on macro trading strategies, on moving average crossovers. But instead, we wanted to write a book. Jason Roney has a chapter in the book but we wanted to write a book that, through storytelling, would teach these lessons. Because it's very easy when you teach someone in a very linear way, the thought can get lost. But if we can bust myths that exist out there, if we can show how this strategy or this process can beat conventional wisdom, the absorption rate from the reader goes much higher. And so the first myth that we bust in here, all right, is that more risk equals more return. Jason actually shows in his chapter that more risk sometimes just equals more risk. It's smarter risk which equals more return. The second myth that we bust, money always finds its most efficient home. Well, as Mirage is displayed in terms of the process he uses to find out, and as Jason is displayed in terms of the regime recognition, money doesn't always find its most efficient home. The third thing, and this is arguably the most polarizing subject of the entire book, is that emotions are your biggest enemy. We have been bred that our emotions, that trusting your sense of things is wrong. And in fact, this incredible man of neuroscience, Nish Scholl, who wrote the book Market Mind Games, authors this chapter, that emotions can be, in fact, your biggest ally. So that myth right there is very inspiring and very a key part of this book. The fourth thing is that diversification is the only strategy you need. Well, that's not true either. True diversification is not a static endeavor. It requires its forward-looking risk. And so again, another myth we bust. The fifth myth, there was more opportunity in the past. We actually show there's more opportunity today. And the myth which brings us to this presentation is that compensation should be based on returns. John, what do you mean? What's wrong with basing compensation on returns? How else would you do it? Well, here's why that's a problem. If I teach you, and everything you do, from whether what Murat showed or what Jason highlighted, is an assessing manager skill, you assess how that manager maximizes return per unit of risk, and you put in place a compensation structure that doesn't reward them for how well or how poorly they maximize return per unit of risk, you've potentially undermined the entire investment process. WTF. So by putting a structure in place that's goal congruent, you can completely recalibrate how managers and how investors can approach the investment process. So, when I talk about the current compensation system, here's what I mean. Let's go through a couple of examples. Example one. For most people know, there's the standard 20% incentive fee. If I give manager A $10 million with a $1.5 million risk budget, or what I dub a unit of risk, and the first manager goes ahead and earns the 20% fee because he had a $1 million max negative drawdown and he made $1 million. Okay. The second manager had a $300,000 drawdown, but made $2 million. So why did both of them earn the same incentive percentage? One clearly maximized return per unit of risk at a much higher level, and that's the problem that we see today. And this can have a major impact in terms of overpaying for beta and not actually paying for alpha. So, my solution, and I'm going to get into a lot of examples of this, is the Netto number. Instead of focusing on the top line, which the myth that we bust focuses on, the profits, we have context in this. So it's profits divided by a risk factor. And I'm going to show you what those risk factors are to give you this very practical formula. It takes about 5 seconds to implement, but it really calibrates and puts a goal congruent structure in place. And then based on that ratio then is commensurate with whatever incentive fee that manager would get. So if we look here, just a couple of salient points from the Netto number. The Netto number is a ratio that measures, factually, return per unit of risk. It balances between the numerator and the denominator. Right now, you make $100,000, you have a 20% incentive fee, it's all about the numerator, it's all about the top line, you earn 20% of that. There's no factor of the denominator, no factor of that risk factor to put in place. It's a simple equation. The higher the Netto number, obviously, with the numerator being the return, the denominator being the risk factor, the higher incentive fee you're going to get. The lower the Netto number, the worse incentive fee you're going to get. It's very matter of fact. It's retroactive. So in advance, you can agree to, all right, for the next year, we're going to put this in place, and then based on that year's performance, or based on that 6 months, or based on that 2 years, whatever time frame is appropriate to that manager and that strategy, that's what you can use to set that up. And again, what I'll spend some time on is explaining what goes into that risk factor. We have the unit of risk, and we have the max negative drawdown. Those are 2 factors that I believe are very important in calibrating that denominator, which is the risk factor, with the numerator, which is the overall return. This, like I said, serves as the context for profits. I wish I could sort of highlight this, but you basically take the